All right, folks, welcome back. This is our Thursday commentary for the ICT Mentorship. This is the daily chart of the dollar index. Lost my train of thought there already. I am getting old. All right, so we're looking at the reaction off of that small little imbalance I mentioned last night, and we corrected off of that down into this small little imbalance here. I think personally that we're probably going to go a little bit lower. Watch this one here. This order block here is the last line in defense for, in my opinion, the near-term bullishness. I'm not trying to pick the top, but I think that we're probably going to want to retrace deeper. Keep an eye on this. Now, if we lose this, we're going back up into these highs, or back down into these highs, rather. And maybe even accelerate all into this. And that would be problematic for the bullishness on this market. And also, this is a long-term bearish breaker too. So I'm giving it the opportunity to prove itself, not trying to be aggressive and say, well, I'm going to call the top there, because everything in dollar has been moving higher since June. Had to deal with the consolidation here, but finally gave way on the upside. Hourly chart on the dollar. Again, you can see the reaction off of that fair value gap. And dug down into the old weekly premium high on the imbalance. And again, these blue lines here, in case you forgot what they are, this is the premium high and discount low of the imbalance on the daily chart. And if you scroll back to your daily chart, you'll see the imbalance that this is. And we mentioned it, for a while now. It's been in the charts. So let's say that the dollar index is likely to continue going lower in a deeper correction. Not trying to call a top, not trying to call the end of the up move. Okay, I'm just suggesting that, let's just say it needs to retrace. Original consolidation, accumulation, reaccumulation, smart money reversal, low risk sell, distribution. The next level of distribution in here could really send this thing down into this level here. So be mindful of that. I'm not suggesting it's going to, but it's something I'm studying myself. 15-minute time frame. Imbalance in here. Trade up into that, sold off. One more time, trade back onto the discount low. Once again here, then give up the ghost. Now I want to talk a little bit about time distortion that's in these price charts. The time between 1800 hour rather, and midnight, that to me is during the time when it's accumulating, it's building up liquidity above and below the marketplace, so that way the algorithm can draw onto the algorithm could draw on that liquidity, whether it be buy side or sell side. We had this premium array here, and we kept breaking new lows. And up close candles, if you study it, all the up close candles that would be bearish order blocks have been respected. And then we had this premium array in here. Does it trade off from there? Yes. Now all of this in here is distorted by time. Even though it went lower, that's fine. But from this high down to this low, that range is not important until it becomes an element of time after midnight, which is right in here. Then this rally up to that level becomes significant. Look at the reaction in price then versus, yes, it dropped off late, in the Asian session, but it's not a lot of movement. This movement here, from this high to that low, then it returns back into that discount low. This is the element of time that's important, referring to when the market goes back to old levels of imbalance or old highs, old lows for liquidity purposes. The aspect of time after midnight, when we trade into Frankfurt and London, that kill zone time that I'm teaching you, anytime price returns back to that, or a time in the previous kill zones, that being the New York kill zone, the London kill zone, London close kill zone. Yes, in Asia, but I don't like to return back to PD arrays in Asia because Asia has its own characteristic, which is majority of the time just accumulating for the daily range. So what am I saying here? In your notes, you want to refer back to areas of imbalance or old highs during previous kill zones, not referring to imbalances, fair value gaps, or order blocks inside of the time when it's dead. Okay, in other words, outside of kill zones, in between London and New York. There's like 2 hours there. It's essentially the whole entire Asian session for the Asian range. Let's say not the session, but the Asian range, and then the movement after London close. Okay, so there's a period of time after London close, all the way up into the beginning of Asia. I'm not interested in that. Okay, so I'm not looking for order blocks in that time frame to refer back to in market structure. I'm not looking at fair value gaps during that time because the algorithm doesn't hold that much importance on that time, which is the reason why time is the first critical element to understanding what I'm teaching you, because it's time and price. So you have to strip away some of the portion of price action that is outside kill zones, which is the real secret of why I'm teaching you those time windows. It's not to trading sessions, because if that was the case, then it would be just simply the trading session times that everybody teaches and what they actually are. No, there's specific elements to this time window that I'm bringing your attention to. That's where the largest volume comes in. That's where the largest commerce and exchange come in. And that's simply how the algorithm is designed to work. So notice how when we go back into this fair value gap here, like you're not looking at this, that little gap right there. When it traded up into that, that would not be, oh, it's going there at midnight and it's going to create the high there. No. Go back into the previous day, and this is during the New York session. So we have a fair value gap there in the New York session and overlap of London close. So this is a real interesting premium array. It reacts there, yes. Then it comes back to it here after midnight. Now we're in that time window again when it's going to be sensitive to significant PD arrays. Where was the last one in the New York session or London close? Right here. And this old high right here, which is a rejection block. Right there, it trades into that. But returns back to the fair value gap. Now, when you see things like this, it's easy to discount it and say, well, you know, whatever. But you need to go through your charts and look at what I'm referring to. Block out the areas on your chart with a rectangle that is not a time window that is sensitive. In other words, after London close, all the way to the beginning of the Asian range. You're not looking for PD arrays and all that. So that's where the time distortion really kicks in. Now, there are times during the kill zones where you'll have consolidation and there's distortion that takes place there. Usually that's attributed to a high impact news event that's looming on the economic calendar, or that day or the day, day after. Or there's high degree of manipulation and you have to refer back to the crosses for that. So this is why I'm saying that you just can't come here, watch a video and think you understand this, and then, or come here, come in for a few months, not even become charter member, throw live money in there because you need to support yourself financially, and then when you fall on your face, that's your fault. You're trying to drive before you've learned how to drive. You're trying to fly an F-16 fighter jet, and you've never been in the cockpit before. So it's not surprising when you see people say, well, I tried to do this and it failed. No, you failed. The logic doesn't fail. These concepts don't fail. Your aptitude is the failure. You can't do it yet. It's not to say you'll never do it. It's not to say you're going to fail forever. It just means that you're impatient. You're not following the instructions when you joined. So time distortion, there's two elements to that, okay, or two stages of it. One that takes place during the kill zone, and that's attributed to economic calendar, which is why I taught you in the beginning. Focus on the economic calendar. And also market profiles. Is the market in trending model? Is it in a consolidation? If it's in consolidation and it's the dollar, That's your tip off. Go right to the crosses for trading purposes, not to trade euro pound, but to trade the crosses like Aussie yen and use the differentials there. Okay, so there's a choice that you have to go through, and you have to go through the analysis aspects of knowing what makes a market consolidated, what makes a market that is holding for a economic counter event. That's experience, seeing what it looks like. That's why you have to see it over the course of 12 months. You'll see that there are times that high impact news can cause the market to freeze up, and the event comes out, usually FOMC or some kind of rate announcement or something that degree, and then you'll have the market release. But while it's doing that, they will use that holding pattern in dollar or similar pattern in another currency to manipulate the crosses. So time distortion is a real event. There's a way of measuring when it is likely to occur so that way you can prepare for it, not be surprised by it. Or if you are trading and you overlook the idea that it could potentially be taking place in the market you're in, then you can either get out of the trade, save yourself some misery and loss, or reduce the leverage that you're in on that trade and then try to trade your way out of it if there's a little bit of drawdown. But the main thing is you want to be prepared as much as you possibly can, looking for previous kill zones and the PD arrays that exist in them. So when I teach you areas where we're not interested in, where it's like where the market's just simply not willing to produce anything that's significant in terms of price delivery, when I'm looking at price, I'm ignoring that. Okay, I'm looking at the times that I expect to see sensitivity. Now, I don't draw the lines vertically and draw boxes on the chart like I do when I'm trying to teach you something or illustrate something to you, because I want your focus on a specific area. But you all know what the kill zones in here are. So if you put those lines vertically on the chart and label them, anything between the kill zones, that is a time when time distortion will materialize. Any other time will form when the economic calendar basically provides the catalyst or reasons why it would enter into consolidation, and it becomes choppy and messy. And that's distortion by time. The way you work with that is you want to look at the last dealing range. And like, for instance, when we got past London close on the 17th, right in here, this was the low, and we just started going sideways in here. This low to this high, that's your dealing range. So what premium array exists in there? Right here. Okay, you see that? So that level of premium array, you extend that out in time. And forget all of this. Okay, this is all sloppy mess. And then when we return back to that level there, after midnight, now we're in what? We're in a time window of Frankfurt and going into London. So what does that time window usually create if you're bearish? The high of the day. What's it form? The high of the day. What's it forming on? What's the backbone behind that high forming? The previous New York session London close overlap premium array. This fair value gap. You see how that all ties together? Now, you can't learn that, obviously. Like if I sat down with you the first time and said, all the things I said in this video, think about what you probably have overlooked in terms of what it takes for you to understand what I just said. Because it's easy once you have all these supported lessons, and well, not supported, but supportive lessons around the things I've talked and touched on in here, in this portion of the video. You take no consideration for how much time you study the kill zones and when they form highs and lows. Okay, it took time to do that. It wasn't just simply me saying, here, it begins and ends this time, and you know everything about it. No, you haven't gone yet into the chart to see, do these things create highs and lows that are significant during that time period? And then you didn't study, without seeing the kill zones on your chart, those periods of no activity between London close and Asian range opening. That's all like illiquid time. That's distorted by time too. So we're not looking for any kind of PD arrays in that time window. Even though your chart has all that data in it, I am not referring to it with any real significance placed behind any of it. Knowing what dealing ranges are, again, just my stating the words doesn't give you the understanding. You have to look at it and study. And dealing ranges are specific to kill zones. Okay, what's the highest and the lowest swing points in the New York session, the London session, the Asian session, London close. And those ranges, inside those ranges, there's where the PD arrays are going to exist that mean something. That's the algorithm is reaching back to those time windows and then those specific elements in price. Everything else outside of all that stuff is distortion by time, because these charts are marking time. No matter what price does, if it just moved around for 2 pips, it's going to create that fluctuation. And that fluctuation means absolutely nothing. But if you refer back to the previous dealing range, high and low, in the previous kill zone, it pulls context immediately right back into the marketplace. And you can decipher what it is that you're supposed to be looking for. So anyway, with all that said, again, we're not done with time distortion. It's just I wanted to touch on it again this week, and this is another element of it. And I gave you the 2 stages of what makes time distortion in price charts like this, because these are time-based charts. This being a 15-minute time frame, whatever that 15-minute interval shows in fluctuation, high and low, whether it be a lot of volatility or low volatility, it doesn't make a difference. It's just only going to mark the beginning, the highest and the lowest, and the end of that time window, that 15-minute interval. That's insignificant information. You don't have enough data there. But when you refer back to previous kill zones and the PD arrays in that, and you bring in bias, what was the bias? Well, we already completed the weekly objective that I outlined for you and went more. Mine was here, and this was extra. But I said it could possibly, be done for the week, and this was, in my mind, something to be paying attention to. And we pulled off of that considerably. So if we have a likelihood that it's going to likely retrace, are we bullish? No. Are we exceedingly bearish? No. We're just looking for it to pull back. So in this regard, this premium array and every low being taken out and every up close candle is holding price at bay. It won't let it rally. So what's institutional order flow suggesting in here for dollar? It's bearish. So cut through all the chaff and the noise between the kill zones and go back to the PD arrays that matter during the New York session, the London close session, and the London session. So by doing that, it gives you an X-ray view as to what price is likely to key off of and reach for. And if you have a bias, whether it be short-term or longer in nature, it gives you the context to work within whether you're going to be a seller at premium or a buyer at discount. All right, Eurodollar daily chart. And I said we'd likely pull up into this here. We've created more or less the low of the week. My expectation is we probably have made the low. We don't likely see a deeper run tomorrow. But be mindful of this little area up in here. And we could see, again, more lower prices on dollar, and that would send us back up into this area here, maybe retouch the 114.20, 114.25 level. And you can see the imbalance that exists in here with relative equal highs. And it just looks like we're just starting to accelerate, maybe run right back up into that on Friday. If it overshoots that old low, we have this imbalance in here as well. 15-minute time frame. Market maker buy model in here. Original consolidation, distribution, redistribution, smart money reversal, low risk buy, accumulation, reaccumulation, another level of reaccumulation, and then starting to rally up. So we do have liquidity around that 113.85 to 113.95. So watch and see if it wants to make a run into that aggressively. Kind of like something like this, but on the upside. That'd be a nice short squeeze. And here's cable daily chart. Dug deeper into this sell sign imbalance, buy sign efficiency. And this one here, On the daily chart, I don't know what it's reaching for, except for this small little short-term low. It has that much more of the upside to go. And we have buy side. Well, these relative equal highs here. To me, it looks too clean. If it gets up there, it doesn't mean that's all that it can trade to, but look at this gap here. What do you see on the other side of it? See that? Balanced price range there. So it could clean this area up and then bang into this area here and pretty much be in rate term high. Or if it runs through this high, then we get obviously more downside for dollar. Long story short, make it real easy for you. Near term, short term bearish dollar, long term holding out whether or not it wants to continue higher, but it did hit a premium array in the form of a bearish breaker. British pound, this is likely to go higher to the areas I'm showing you in here. We have a small little gap there and here. And yesterday I mentioned this one here, and we ran right up into that, overshadowed by a little bit, and then sold off into this imbalance. So that was a trade idea that you could see right there panned out. If you look at how we went from this level, which was over here, then sold off to this level here, which is a discount, and then using this range here, if you bought in here, we're going to look to see a possible return back to that same imbalance, which is here. So short, buy, short, or sell the long. 15-minute time frame, again, imbalance, bullish order block, trades down into that. Look at this right in here. Small little gap there, breaks down, swing lows taken right there. See that? You don't need this one broken, just this one, because the context is that was the premium array and that imbalance on the hourly chart. We broke down, rally back up, small little imbalance there, optimal trade entry, and look at the bodies respecting that gap. This is the premium high. Perfect. That is perfect signature. When you see that kind of stuff, that is encouraging. So at that moment, where do you see price reaching for? Well, you have relative equal lows here, and then you have this gap here, and this gap, discount low and premium high. That was on the hourly chart, but it's refined to this on the 15-minute time frame, and it trades down into that order block there. So selling short here, drops down, one more time pumps into this imbalance, and then a nice run into this imbalance. Then accumulates in here and runs right back up into that imbalance again for consequent encroachment, which is where the bodies are basically residing. All right, folks, the Nasdaq 100. So here we are, another one of those hindsight things where the things I outlined, what to look for, pans out again. And this is mentorship. This is what I'm talking about. By guiding you, suggesting what to focus on, so it gives you the bias. You don't go in there looking for tops, okay? You go in looking for longs to run this high out, okay? So we've completed that. Now the question is going to be, where's it going to go now? ICT. We've never been here before, so the moon, okay? I don't know. It could go anywhere. It could literally start going into some kind of parabolic run higher, and with the velocity that would tear a face off of somebody, and it could easily produce something like that. It's producing the relative strength across the averages, so it's performing on the upside better than S&P and in the Dow. So I don't know. If we lose this high here and we take out Thursday's low, that's bearish. There's no reason to come back down below that. So as long as we're above Thursday's low, this thing is bullish. On the hourly chart, again, that's that old daily high. Buy side resides there. I said that's where we're going to draw to. And we consolidated in here. I said we're not done. I think we're still going to go higher. And we were going up. And then at this point here, we'll look at this on a 15-minute time frame also. But notice that we're creating higher highs here ahead of the stock exchange open at 9:30. Then we have a decline that trades back down into what you'll see is a order block right here, but I'm anchoring it to a 15-minute time frame. But if you draw it over here, it's this order block too, but it drops aggressively in here. with SMT. Now, I got an email from one of the students that said they were frustrated because, number one, they look at SMT and they don't know what direction it's looking for or assisting them with. And SMT is not a timing tool, and it's not a directional tool. Okay, it's a confirmation tool. Okay, it confirms accumulation or distribution. That's all its usefulness is. It's nothing beyond that. So just don't try to look at a hammer and think of it as a screwdriver. Okay, that's what you're trying to do sometimes with these tools. Not this student, but some of you in general that come in, they fly through the content and they don't really listen to what I'm suggesting about it. I'm giving you a lot of details and logic as to why these things should work, why they would likely fail, where they will, and how to get through those instances, and what tools are useful at what time. When you hear me teaching like that, it's boring to you because you want something XYZ, 1, 2, 3, this is the way it is, it's never going to be any deviation from that, and I know exactly it only works this time of day and it always works without a loss. That, I mean, if you're honest with yourself, some of you are like that. And that's normal. I felt the same way. It should be black and white. It should be binary. It's not. So you have to come up with rules that make your model binary. Let me say that again. The markets are not going to move in a binary sense because there's so many variables and things and time elements and manipulation that comes in the marketplace. It is not binary. Your model forces a binary perception of price. This or that. Buy or sell. Trade, sit on your hands. Hold, get out. You have to have these binary functions defined in your model that makes you come to these conclusions. And they have to be well written, refined to the degree where you know what you're looking to do and why. You don't need a long speech around everything you're doing. That's the understanding that comes by being with me. But once you understand these specific signatures, you don't need a long-winded note-taking session when making your model because you know the logic that makes a bearish breaker a bearish breaker or a bullish order block a bullish order block. Okay? So, and the overall structure of a market maker buy model, which is what we're looking at right here. Do you see it? Consolidation, distribution, redistribution, smart money reversal, low risk buy, accumulation, reaccumulation, another level of just accumulation rather, and then once more before we clear the original consolidation out. Okay, all this sideways action, there's buy side built up around that. Now, you don't see this logic and framework in that daily chart. Notice that? You just see a market that keeps reaching up to an objective we were looking for, which was this old high. But when it retraced down here, I gave you this in here, all of these price points are discount arrays. Every time the market drops down, it's creating a Judas swing. It's dropping down to accumulate new longs. When should it drop down? After 7 a.m. New York time. That begins the New York session. The AM session for equities or index futures, or in this case the CFD of the Nasdaq, it's 9:30 to noon, and then 1 to 4 for the PM session. So it helps you divide the day. The order block in here, when it drops down once more, notice we're going up in here, we're creating higher highs. We're going to look at that in relationship to the Dow and S&P. They were not supporting that higher high there. That created this retracement. That's what you would be waiting for. How far will it drop? Well, you have this order block, and look at the low to high. Deep discount array, and it's a Judas swing, and we have yet to clear the buy side. So this is all manipulation to wash out traders that are long because they don't want them to participate in that rally. And here's a 15-minute time frame, 7 a.m. That's like a midnight divider, okay? Think of that for trading index futures. Put your 7 o'clock in the morning line on there. When you're bullish, you want to see a drop down into a discount. Over here, vertical line would be right here. You're bullish. We've been bullish. Do we see a market dropping? Yep. Judas swing. Okay. You want to see that signature because it's going to invite you to seek a long position when everybody else is going to see a market just tanking. This one today really dove deep. Order blocks are sitting right there. Ain't hiding from you. Small little fair value gap right there. And your order block trades right down into that. Rallies away. Retests that level there. And then off to the races. Exactly where I said it was going to go. Where you knew it's been going for a while now. Now, left hand side we have the Nasdaq 100 hourly chart. We have higher highs here. And the S&P, we have lower highs. And the Dow, lower highs. I know it's hard to see here like this, but when you look at your own charts and compare them, it's pretty obvious. And we'll look at the 15-minute time frames a little bit better. But the market tanks. Notice what's happening here. We're trading into the order block here on the Nasdaq during the New York session Judas. When we're bullish, this is tanking. Over here, the S&P comes completely below the relative equal lows for a low resistance liquidity run signature. See that? The higher low on the right of the low. It washes that out. The Dow just trades lower. And this one is decidedly weaker. It just keeps going lower and lower. We have divergence across the board on these highs. You can see it right here. The S&P, the Dow, and the Nasdaq have not confirmed the highs. So that's why I'm expecting some kind of a blow-off move where it goes higher and then prices in some significant important high. And if these don't catch up, we could see a pretty wicked drop on Nasdaq. I'm not suggesting going in there trying to capture that. I'm just suggesting that you need to be prepared for something that bad because it could happen. I'm not saying it's the top. It just means that we could really see a wicked reversal that takes out a lot of these lows here, here, and here. And the 15-minute time frame. Nasdaq, higher highs. See that? Same highs in S&P. It's not going higher. Where this went, higher here versus that high. This high is going lower versus this high. This is heavy, heavy, heavy distribution. Another level in here, high and then lower high. So we're not seeing communication between the averages that would confirm that this higher high in Nasdaq is valid. So this is a stop run here. It's going to go down. Now you can use this two ways. You can sell short. I shorted here, bought more, and built a pyramid up in all of this here, and then in here as well. And I'll show you, the result of that today. But over here, this dived down. While it did have a nice retracement to make a higher high, it hasn't shown much in response to the higher high that's seen over here. Because, as I showed you on that hourly chart, it dug down into a discount bullish order block on the hourly chart on Nasdaq. And this low was higher. Let me go back and show it to you. We had the low and the higher low there, where we had the low and the lower low there. See that? These are lower, these are higher, and these are lower. So which one's the stronger? Clearly, the Nasdaq. So it's unwilling to go lower. So the algorithm is tipping off smart money, saying, okay, this is the one that's, you want to pour your money into this one and go long, and it rallies up higher and stronger and outperformed on the outside. Even though this was here, that SMT divergence warned of the Judas swing that is seen on all three averages, and the Dow just couldn't even come back to the old highs here. But this decline in here showed SMT divergence here, warning of a retracement lower, and this being a stop run. Then, after the decline, we go into order block and it confirms a bullish SMT divergence. It's confirming that accumulation is actually occurring down here in Nasdaq versus the S&P went lower and then the Dow went lower as well in response to its hourly chart. I know it's confusing, and I know it feels like, it should be so simple. You listen to me say it one time and you understand it. But the only impediment you have is you're trying to force SMT to talk all the time. Okay? And that's always been the case. When I was teaching it on SMT studies on YouTube, everybody would look at the wrong lows or the wrong highs, or they would look at things backwards. And they're trying to make things fit a move in the price action, when you just have to compare relative highs and lows with a underlying bias. So now think about what I'm going to say here. This is the beginning of the New York session when it's running up like this. At 7 o'clock, you're expecting a Judas swing. What has it been doing up to 7 o'clock? Going higher. So if you're trying to buy a deep discount like smart money will look to do, were we not bullish on Nasdaq? Have I not been telling you where it's going to go? I told you it was going to go to a new high. I did not suggest that we were making a high, okay? We were looking for accumulation and to buy. So when you're trading index futures, you want to treat 7 o'clock in the morning the same way we do midnight at New York in Forex. That's not to say there isn't setups in the New York session. I'm sorry, the London session overnight. There is. But if you're an index trader, the majority of the volume is coming in during the New York hours. So if you are a New York session mindset trader, regardless of even where you live at, whether you trade the New York session in Forex or if you trade it in index futures or CFDs, you need to anchor your expectations around that 7 o'clock hour. Because if you're bullish, don't take my word for it, folks. I don't want you to just take it and say, oh yeah, I believe because he said so. Go into your charts and see when we're bullish or when you see price obviously going higher. Put a line vertically at 7 o'clock. And when you're bullish, you're going to see a Judas swing drop down. It's going to an order block, or it's wiping out sell stops or reaching into an imbalance. It's going to a premium after it goes down first. So we're getting that Judas swing. We've had Judas swings just about every day this week. So again, you have to know where it's drawing. Where is it likely to get pulled up to or pulled down to? And is it being anchored on the logic around the higher time frame? Yes, because I did it on the daily chart. I showed you that we were reaching up into the daily high here. We're down here. It's going to go higher. It's going to go higher. It's going to go higher. This is just a small little blip in the individual up move. And a down day is welcome because that gives you the strength to go higher the day after or the very next day. Well, there you go. Boom. And it pumps up into the level we were looking for the buy side. Folks, this is not hard if you listen to me. I'm taking your attention to where it's likely to go. But then your job is to go in and take these individual components and pour them into your charts. In hindsight, that builds pattern recognition. Once that pattern recognition has established itself, and it takes months to do this, then when you get into the lower time frames and you're watching them live, you can anticipate these drops down just to accumulate longs and then deliver where we're looking for. But if you're zoomed in on a 1 minute chart on all this is going to feel like the Armageddon. Okay, the world's ending. 70, 90 pips or whatever dropping down like that. It's going to feel like your face is being ripped off if you're trying to go long. You have to take a step back. In all the framework you see here, the market maker buy model, in this drop down, we did not yet take out the high. So this is dropping down just to a discount. Order block on the 15-minute time frame, digs into that, starts to rally up. If you go into the 5-minute chart, you'll see more details in here where you can use smaller bullish order block after it creates this short-term spike in the order block. Then we get into this retracement after retraces consequent encroachment. This low, this high, trade right into that, accumulates more. Look at the lows in your S&P and Nasdaq and Dow at these lows in here. Low, low, not low. That's the cracking correlation. So I got a question also, why does the averages not agree? Like, what's the reason why SMT even forms? What causes that? That's the understanding I got, or at least what I thought the question was being framed around as by the student. And if that's not what I garnered from it correctly, please send me another message and I'll quickly do it again. But I think if I understood you correctly, the question was, what makes this SMT divergence right here versus this lower highs, and higher highs? What causes that is the algorithm is going to reprice higher on one or more of these three averages and not reprice equally to signify that that is an area of distribution. So that way people that are in the know, okay, that they're in the know, they look for that as a confirmation that they should either be getting out of longs or going short. They all drop. Notice that Nasdaq drops down about 90 pips or points or whatever handles. And then we have this lower high here, and it really escalates on the downside. And then the Dow really falls out of bed too. But the one that's underlyingly more stronger to the upside, in other words, more bullish, which is signified by that hourly chart, the Nasdaq failed to make that lower low there, which is what you would be expecting because we were looking for a higher run on Nasdaq. We're not looking for the underlying strength to exist in S&P or Dow. We've been focusing on what index? Nasdaq. Did I have your attention on the S&P? No. Did I have your attention on the Dow? No. That's not coincidence, okay? I'm teaching you by example. I'm taking you into the charts. I'm putting you right where you need to be looking. Yes, there's moves happening in the Australian dollar, okay? There's moves happening in crude oil. There's moves happening in gold. Bitcoin's moving around too. I could care less, okay? Your idea of focusing on one thing for the time being to learn. Once you understand how to do it, then you can go anywhere you want and play, okay? But you have to know how to look at related or closely correlated markets like these three averages are and be able to ferret out which one has the strength and which one has the weakness. And then what does that mean in context? Well, I gave you a lot in this video. I told you how to frame your day and build your routine for the day. Remember I said I was going to talk about that this week? Every single day, if you're going to be studying indices, and you should be, in the fall months, you should be taking some of your time and allotting it towards these three averages. And do it until around, I don't know, maybe the first week of February. And then relax and don't do anything for a little while with it. Go back to watching Forex, okay? And maybe commodities. But the fall months, you really want to be focusing in on these three averages because the volatility, the opportunities, the setups are just beautiful. They're really, really nice. And they provide a lot of momentum and velocity behind specific price moves. So your day, when you begin, should you be a New York session trader? And I really advocate for that because it gives you all the advantages of having London behind you. Yes, there's a lot of you in here that want to, beat the brakes off of London. There's nothing wrong with that, but just know that there's an inside advantage over New York versus the London session. London session can get, well, you might think you have it, and then it takes it from you. And then for whatever reason, when I was coming up and trying to teach myself to trade Globex, trading the S&P market overnight, that's what we used to trade, the Globex market. And I would look at London sessions, and sometimes I would take a loss, and it would completely debilitate me, and I couldn't do anything in New York. I would be afraid because I took a pretty good lashing, overnight, and I wasn't able to sleep because of that. So in the 90s, that was very hard for me to overcome. To avoid that, don't think that you have to have some kind of badge of honor, like this kid ego stuff, where you're a London trader and you're getting the high and the low of the day every single day. You don't need to do that. Use your time equitably and sit in front of the market when it's the likelihood of delivering the highest probability and odds in your favor. That, my friends, is simply 7 o'clock in the morning to 10 o'clock in the morning. That sweet spot of time. And it's not even a lot of time. But that whole period of 7 a.m. to 10 o'clock in the morning, that right there, that gives you all you would need. And if you want to advance into the 11 o'clock hour, just to give you a little bit more cushion into the London close for the reasons of Forex 2 confirming certain things, then do it. Let's talk about 4-hour window. You only need 1 day a week that has the economic calendar behind you, your bias, the technicals, the Judas that delivers based on that bias. That's it. Your whole work week is done. There's a book that's out there, 4-hour work week. I facetiously used to say to my oldest sons, I said, look, this is like that book, 4-hour work week. You only need to find one of these. And because there's a lot of moving parts to this logic that I teach you, it's real easy to get captivated by something new you just recently learned. And because you liked it, or you liked the lesson I produced and taught it in, it resonated with you, you want to bring it with you. It's like your security blanket. Well, I like that, so I want to put it in my model. I want to put it in my trading. SMT can't be forced. Okay? The divergence at key highs and lows, you have to have the expectation of this forming. Otherwise, the fact that it's doing it means nothing. And I'll say that again. We have been bullish on Nasdaq. I've not taken your attention to S&P. I've not taken your attention to Dow. I've been putting your attention right on Nasdaq 100. I said, focus on that high because that's where it's likely to go. I believe it's going there. Today, it delivered. Okay? I'm not patting myself on the back. I'm literally holding you by the lapels right now because some of you are very stubborn and you're doubting and you're concerned and you're worried. Okay? You need to relax. Remember where you are. I'm telling you what's going to happen before it happens, and your charts are printing it later on. That has not stopped. The tools that I'm teaching you are working. They're delivering. They're showcasing themselves. But you're trying to make them do things they're not designed to do. SMT is not directional. SMT is not timing. It's confirmation. The only thing it does, and it does exceedingly well, is it reveals accumulation and distribution. What am I saying by that? Well, when we're looking at these lows, relative low here to here, this is being accumulated. Why? Because it can't go lower. At the same time, this low is being violated here. This is under heavy distribution. The fact that this low was taken out by that one gives you the indications that this high is less likely to be taken out, whereas this high is easily going to be taken out in the high that it formed prior to the decline. So it's going to be easier for this market that showed accumulation on the lows. It's going to be easy for it to springboard higher and reach for new buy-side liquidity. Whereas over here, this low being taken out with this one, this is an SMT divergence in the sense that this is a negative and this is a positive. This was unwilling to go lower than that low. Where this low was easily pierced by this one. And notice while it did come back, it didn't make an attempt to get through this high as quickly as this high was completely overlapped and ran higher. And the same thing can be said with the Dow. The low here, crushed. And it couldn't even come back to the old high here. This one's really weak. So, SMT qualifies, confirms. It gives you the final check in the checklist of, okay, I'm expecting this market over here, the Nasdaq, to be bullish. If that's the case, if it's dropping down, at the same time this thing is just careening lower, this is going lower, this one should not go lower. Where should it stop at? Somewhere inside this order block. because that's your discount array. Now we have SMT, we have a bullish order block, lower lows in S&P, lower lows in Dow. It does not mean wait for this one to go lower too. Big paradigm shift right there. When you see this thing dropping hard, don't forget, this is why you have to write down your plan. What's your plan for the day? I am looking for longs in Nasdaq. I'm looking for longs after 7 o'clock in the morning. I'm looking for a decline into a discount array. I want to see the Nasdaq not go lower than the S&P and the Dow. Now, some of you might hear me say, oh, you're only saying that, Michael, because it's what happened. No. My attention has been on the Nasdaq. I said it's going to go higher. You know, because of the lessons I've taught in this core content, that if we're looking to go long, we want to be buying the low or very close to it. In indices, you have a high rate of accuracy by putting a vertical line on your chart at 7 o'clock in the morning New York time. And then, if you're bullish, you want to see the Judas swing occur after 7 o'clock in the morning. That's when it's going to form. It doesn't mean that there won't be another lower low formed at 9:30 when the stock market opens up. You can have a real big volatility event where it washes out that short-term low that formed not long after 7 o'clock in the morning. And there's nothing wrong with that. You might get stopped out. You might take a loss. But you still stick to the idea that Nasdaq is the one I want to be buying. And it's giving me the indices support by having weaker prices and lower lows being formed in Dow and the S&P. And I should not expect to see that form in the US 100 or Nasdaq. And that's what you have here. When I taught you relative strength analysis in here, not the indicator relative strength index, the relative strength analysis, this is what this is. When you're bullish, you want to be buying the one that fails to make lower lows. When you're bearish, you want to sell short the one that fails to make higher highs. Whereas we had higher highs here. Yeah, it dropped, but not by much. You don't want to sell short the Nasdaq with the expectation that's going to be the overpowering outperformer. When you can compare the S&P, lower highs, the Dow, lower highs, big decline, really big decline. Yeah, tradable decline, but hold on to it too long and it's going to rip your face off. Do you see the difference there? There's a glaring characteristic contrast between what I'm showing you here in the Nasdaq versus the S&P and the Dow. You will not fully absorb it, especially for the 2021 group. You're going to look at this and say, it's just going over my head. Something's just not right. He's not teaching it good. And I'm teaching it perfectly. The problem is you have not been supported by all of the other lessons that this requires you to know that's already taught in the core content. And where all of you are, everyone in the mentorship right now, regardless of whether you made your next month payment or not, you are all at the point where you would know these things. Because I've harped on it in the commentaries daily and multiple times a week. It's in core content lessons also. And it's in the commentaries from each month, core content. So, I covered daily routine. I covered time distortion. I delivered again this week with in regards to where these markets would likely reach to. I'm not real happy with the dollar and the euro side because they went a little bit further than I wanted, but that's okay. I'm just revealing I'm not beating myself up. I'm just saying I wish I would have spent more time looking at those charts on the weekly because I never looked at the weekly and I completely missed it. Otherwise, I would have gave that level to you on the dollar. Let me take you back up to it. Actually, let's go back to it this way. This here, I would have seen that if I would have been studying the weekly chart earlier over the weekend, but I didn't see it. So by not doing that diligent study, I missed that opportunity. Otherwise, that would have been really cool because I would have said, that's what we're going to look for the weekly high. But it's still delivered here. I even had the weekly chart. I just didn't even see it as possible because I wasn't looking for it. Once I put the annotation of this line here on the chart, I just got busy talking and just never really worried about doing anything beyond that. And personally, it's okay. If the market runs up here and hits that level and that's allowing you profitability, who's going to argue with that? And that's really what I want to get at, because sometimes the markets, I'm getting out at really decent highs and lows, but it always goes a little bit more. This is one of those instances where I'm talking about where it happens. This is it. I may never fix it entirely. I may never really improve it. But my question to you is, would it matter? I don't personally think it would matter, but my obsessive compulsive disorder makes me make a big deal out of it when it's really not that big of a deal. Especially if you're developing and you are able to find the moves and see the directional bias and the draw and liquidity and what you should be expecting to see in the daily range. All these things come together. It's like a beautiful tapestry where the individual threads are what you're becoming accustomed to in the core content. You're holding individual threads. And then as you go through each month and new week of commentary, I'm teaching you how to take these threads and put them together. And at the end, when you come to your own model, you'll remember these threads individually, but when you take a step back and look at it, you're going to see something really beautiful that you yourself are going to love and respect, because you put the labor of love and effort into making that model unique for you. And if you share it with somebody else, they're not going to see it the same way you do. Oh, that's neat. I don't like that part. Why'd you put that in here? I had this instead of that. And if you are cynical and you listen to people like that, or if you have that mindset, first of all, it's stupid to have that critical opinion of someone else's model. If it's working for them, there's no reason for you to give your opinion, because I can tell you right now, nobody's opinion about what I use to trade with matters. None. And once you get your model, you're going to see beauty in it like it's your own child. Like you won't see any flaws. You'll see strengths and areas that are not as strong, but you will not see weaknesses. And that's important. It's not overconfidence. It's, appreciation for your creation. And once you have it, and you have it dialed in, not only on paper, where you have it spelled out what you're doing, why you're doing it, but internally, it matches your personality. It matches the psychological makeup that makes you who you are. And what does that mean? You're not trying to be a system trader that uses higher time frame, long-term position trading and trying to trade short-term intraday fluctuations. It won't work. So by having all these things work together, but taking small bites of this thing as you go through the mentorship and you spend time as a charter member, trying not to rush. It's so hard. I know. If you want to make money, I know. But you have to figure out the things you're going to do that's going to mess you up and then fix them. I can't fix them. No other person out there is going to fix them for you. But once you've done the work to replace them with good habits, then you have the potential to do the right things and see the results you're looking for. But even then, you got to grow. And then once you do those types of things, you get experience that can't be bought. You can't put a price tag on either. You can't, I can't put a level of money on the things I've learned in my experience that I have right now, that I can't even find a way to articulate. There's no words that can really explain what I'm really tapping into. I just know the painful lessons, they are meaningful to me, and they help me do the things that you see the results of. I sit out here every single week with you, and I more or less mark out